Hey, everybody. Is the economy starting to show signs of cracking? Well, that's what we're going to discuss today on this episode of SRT Live. I am your host, Sean Richard, with the Sean Richard Mortgage team here at Guaranteed Rate. So thanks so much for joining me today. Last week was a gangbuster week in the real estate and economic markets. We had a lot of information data come out. We had the Fed with their meeting and their changing of the rate of the Fed funds rate. We're going to get into that today as well. So lots of information to get to. So let's go ahead and jump in and look at a review of what went down last week. So first, let's start with some housing data. We got pending home sales from the National Association of Realtors last week. The analysts were expecting a decrease of 1.5% in pending home sales month over month. And we actually got a much worse report, came in at 8.6 to the downside last week. Now, the home sales declining is really going to be for a number of reasons. We've seen the decrease in inventory, and we can't sell what we don't have. We've seen a tick up recently, but in general, we're still significantly lower than we've been in months and years past. So we got pending home sales. We also got the Fed decision on the Fed funds rate. And this was the gangbuster one. This was the big one. The Feds increased the Fed funds rate by 0.75%. Now, there was some rumors that maybe they would increase it by a full percent, but the majority of consensus and analysts thought it was going to be at 0.75%. And that's exactly what we saw. Now, the Fed came out and said that they are leaving the door open for a significant increase in the next meeting in September. Now, doesn't mean that they will. It's going to be data dependent, as the Fed always states. So depending on what that comes out with, we could see anywhere from 0.5 to 0.75% increase in the Fed funds rate come September. We also got annualized GDP. Now, GDP, we get 3 readings for each quarter. So this was the first reading for Q2. And if you recall, Q1 GDP was a negative 1.6 reading. The analysts were expecting a positive reading. Some were expecting negative, but we ended up getting a negative 0.9 reading on Q2 GDP for that first reading. And the importance of this is this would be the second consecutive quarter that GDP came in negative if we get negative readings for the remaining 2 readings, which is going to be in August and September. Now, as an economy, we have never had 2 consecutive GDP readings in the negative without actually eventually going into recession. So this is a major economic indicator. Even though you've probably seen online in the news, the government's kind of been messing with the definition of recession, but 2 consecutive quarters of negative GDP is a pretty significant indicator, even if they're no longer calling that the specific definition of recession. Now, we also got jobless claims on Thursday, and this is broken into initial jobless claims and continuing. Initial is going to be individuals filing for unemployment for the first time, and the market analysts were expecting, the previous reading on this was 261,000, and the current reading was 256,000 for the week. Now, you might think that's a decrease. Well, it's a decrease, but you might think that that decrease is significant in meaning. However, the previous reading was actually revised up by 10,000. So we're still at a higher level than we've been at since earlier in this year. The 4-week average is up about 6,000 to 250,000 compared to what we saw earlier in the year when the weekly unemployment claims for initial claims was floating in the just over 200,000. Now, we also got continuing claims. The previous reading, 1.384 million, and the current reading, 1.359. So it dipped a little bit, but we're staying in that mid 1.3 range. We want to watch these numbers to see where they go in the coming weeks as we continue to hear of companies laying off employees. That's going to be, again, another big indicator as potential recession looms. Now, we also got the Fed's favorite measure of inflation, which is PCE, and that's personal consumption expenditure. I'm killing it today, guys. Personal consumption expenditure. And so this measures inflation at the consumer level. And month over month, the expectation was an increase at 0.5% in the inflation numbers. We actually blew that out of the water. It came in at a full 1%. So inflation still running hot in the economy, although we may have seen that peak in June and July, but we're only going to know that over the next couple of months as we get additional inflation readings. Year over year inflation, the expectation was 6.7%. We came in at 6.8. So although we got a really hot month over month number, year over year, we only ticked up a little bit. Remember, this is a 12-month rolling average that we see. So as a new inflation report comes out each month, it drops the 13th month off and gives us our new range. Looking at this week, so today we got the JOLTS report. What the JOLTS report is it's job openings. And I'm going to pull this up for us because it was real time. So the JOLTS report measures job openings in the US, and the job openings actually declined a little bit. And that's not necessarily unexpected. We have been seeing a lot more layoffs lately across the economy. You're hearing about it in the media. And so just one more way that we can determine what direction the economy is heading. And let me pull this up for us. So we saw that decline a little bit month over month, and we want to watch that as another data point going forward as we measure whether or not we're gonna, not so much that whether or not we're going to be in a recession, but really the depth. I think by now it's pretty safe to say that a recession is either currently happening or we're going to be in a recession. So the real question is how deep of a recession? A shallow recession may not be as negative for a lot of people across the country. A deeper recession could cause some challenges. So we got that today. Then looking ahead this week, we've got a relatively light week for the most part, but we do end the week with a bang. So Thursday, as always, we get jobless claims, both initial and continuing. This is something we want to continue to watch to see the trend of that direction. But Friday, we get two major components of the economy. We get the BLS Jobs report. This is from the Board of Labor and Statistics. And so this tells us how many job creations happened last month. And we're going to get the unemployment rate as well. The unemployment rate last month stayed the same, but there's two surveys when it comes to the unemployment. The first is the jobs report survey, but the second is the household survey. The household survey is actually what determines the unemployment rate. And so they're not necessarily measuring the same things or coming to the table with the same data. So it'll be interesting to see where unemployment looks this Friday from the household survey. Now, what do we want to watch going forward as we continue to monitor the economy, the health of not only the economic environment, but also our housing market? So when it comes to unemployment, we want to continue to watch weekly jobless claims and see where that trend is going. The Friday jobs report is going to be a big indicator as well, along with the unemployment rate. When it comes to inflation, we're going to look at the continuing Fed rate hikes. The Fed's next meeting is in September. Are we going to see another 0.75% increase? Or if inflation reports between now and then subside, are we going to see a smaller increase, maybe 0.5%? Or maybe we see inflation fall off a cliff and we see little to no Fed rate hike towards in September. So that it's going to be important to watch. But remember, Jerome Powell, Fed chair, did leave the door open for a significant increase, such as 75 basis points. But I think the market consensus at this point is we're likely going to see a 0.5% increase in September at the Fed meeting. And then the other note on inflation is going to be a reduction in wage pressured inflation. We've got companies that are laying individuals off, laying employees off, and that's going to create less wage pressure inflation. Through the past, 6 to 8 months of this year, we've seen payroll wages rise pretty sharply across the entire country. Now, I'll give you, it is based on probably industry specific, but we've seen a lot of wage pressured inflation. We've seen employees have a very much upper hand in the labor market due to the supply of job openings and the demand. So we could start to see that subside, which is another indicator of recession on the decline. And then lastly, the housing market. So we've got inventory that's been climbing recently. If you're a real estate agent and you're watching this, you know that we've seen inventory tick up lately, as it tends to do in the summer months. And we've seen demand diminish from rising prices, rising rates. But the good news is we've seen rates decline a little bit since the Fed rate hike last week. So mortgage rates liking the Fed rate hike, moving down slightly from some of the highs that we saw in really June is where those peaked. And then just as an anecdotal side note, I have a lot of conversation with real estate agents, with clients, with title companies, and they're seeing a cooling of the market across the DFW Metroplex, but when homes are priced well, or right, I should say, in line with the market, we're still seeing a relatively rapid sell-through rate. So when homes are priced well, let me repeat that. When homes are priced well, we're still seeing homes sell relatively quickly. It's not going to be the same day, 24, 48 hours that we've seen over the past 6 months. But if a home is sitting in the market for 1, 2, 3 weeks, we're really entering into a more normalized market. It's not that the housing market is crashing. It's that we're simply seeing some normalization. So I want to share one last thing with you today before I let you go. And that is what mortgage-backed securities are doing. Now, mortgage-backed securities are what primarily drive interest rates. And when mortgage-backed securities rise, interest rates decline, and the reverse is true as well. So let me go ahead and pull this up and share it with you. All right. So this is real time, the chart of mortgage-backed securities. This is the universal 4.5 coupon. And as you can see, we've since May, we've had a pretty roller coaster of a ride. But really, here we are. Middle of June is where mortgage rates kind of peaked. And as you can see, mortgage-backed securities kind of hit their trough at that same time. And we saw some trending in the upward direction. Now today, not so much a great day in mortgage-backed security land. So although we've seen some really positive movement with interest rates over the past several weeks, today, not so great for mortgage rates. So if you've got clients that are looking to purchase a home, really important that they act relatively quickly. They want to find the right home, but we've enjoyed a really nice improvement in mortgage rates over the last few weeks, and it would be a great opportunity for them to take advantage of that in case we see that reverse course by a larger margin over the coming weeks. So that is what I've got for you today. Thank you so much for joining me on this episode of SRT Live. Again, I am your host, Sean Richard, with the Sean Richard Mortgage Team. If you've got any questions about the market, or you want to talk mortgage, or maybe you're a real estate agent and you've got buyers that you just want to make sure they've got the best solutions and they've got the most information as they make their decisions, then feel free to reach out to my team and I. You can always hit me up on the number below here. Feel free to leave comments down below. Happy to answer any questions. Until next week, take care, and I'll talk to you then. Bye.